Hello everyone and welcome to our lesson on risk management. Risk management is one of the most important topics in all of day trading, so please don't skip any of this lesson and really take it to heart. Risk management will allow you to stay in the game long enough so that you can actually reach consistency in your own day trading. So with that, let's get into it. Alright, so real quick we'll go over an outline of what we're going to talk about today. First, I'm going to just give you an overview of risk management as it relates to day trading. We're then going to give a brief introduction to the 4 major risk types that you'll face as a day trader, and then the rest of the lesson will be focused on mitigating each of these different risk types. Okay, so let's start with just a quick overview of risk management. In my opinion, as I said at the start of the video, it's probably the single most critical skill set that you can learn as a day trader. I would estimate probably 90% or more of first-year traders fail because they don't follow good risk management guidelines. And risk management is not just related to how you execute a trade, right? It's not just, oh, I shouldn't have put my entire position into GME at the very top, right? There's so many different layers to it that a lot of new traders don't think about until it comes out of nowhere and bites them and blows up half their account. So if you think about kind of this pyramid of success in day trading, right? How do you reach profitability? In my opinion, the first foundational layer is risk management. So pay close attention and we'll get into it. All right, so now let's get an overview of the 4 major types of risk that you'll face as a day trader. The first of these is executional risk. Executional risk is mostly in your control and it's related to how you actually execute your trades. So, we talked about things like type 2 slippage and liquidity issues that are avoidable but not really in your control in the last lesson. Today we're going to be focused on things like position sizing, stopping out, whether or not you use margin. And all of that, again, is basically in your control. Now, the second type of risk that is largely out of your direct control is market risk. Market risk are things like trading halts, regulatory news halts, economic news announcements. You can't do anything about them, but you can avoid them and you can be aware of them ahead of time in a lot of situations. The third type of risk that you'll face is structural or systematic risk. These are things like internet outages, computer failures, power outages, things that you probably don't think about until essentially it's too late and that you need to for sure have set up ahead of time before you're ever trading with real money. The last type of risk that we'll briefly hit on today, because again, in section 3 of this course, we're going to be talking in great lengths about psychology, but this is how you handle loss, you personally. What is your mental game? What is your level of self-discipline? And again, it's so critical that I've dedicated a section of the course to talking about it. So those are the 4 major types. Now let's get into how you can actually mitigate each of these risks. Okay, so first let's talk about mitigating executional risk. These are risks that are related to actually executing your trades that are mostly in your control, right? So we mentioned things like the position size you take, when you stop out, whether or not you use margin, and then the avoidable items that we talked about in the previous lesson, like type 2 slippage or liquidity issues. So on the next few slides, I'm going to talk about a couple techniques such as trading in fixed risk, utilizing hard stops, and understanding margin. And on the previous lesson, we talked about the fact that you need to avoid very low float or very illiquid stocks, okay? And so I'm not going to hit on that here either. But the one thing I do want to talk about on this slide in detail is enabling a max loss protection on your broker or your platform. So I use Dash Trader Pro. You can actually set a max loss for the day that once, I lose more than $500, let's say, it will actually liquidate my positions if I'm still in any, and then it will not allow me to take any new trades for the day. You absolutely must do this at the beginning of your trading career. You think right now, oh, I'm not a very emotional person, my psychology game is pretty good, I'm going to stop myself out and I'll be fine. I promise you won't. I promise that when you get to that max loss, the first couple of times, you're going to get very emotional and you're going to want to keep trading. Setting something like this and not allowing it to change will keep you from blowing yourself up when you have these kind of mental breakdown days. And it will happen. It happens to everybody. So enable a max loss on your broker platform. And honestly, if it's possible, even tell them, I don't want this to change until a set date in the future. So that is how you mitigate executional risk. Now let's get into specifics around trading and fixed risk, utilizing hard stops, and understanding margin. So let's start by talking about fixed risk. In day trading, R represents the fixed risk amount that you will lose if you take a full stop out on that trade. R can be any amount, right? You can risk $5 per trade, you can risk $5,000 per trade, and it really has nothing to do with the actual position size that you're taking. So in order to calculate our position size on each and every trade to maintain a fixed risk level, we need to take that amount that we're risking, our R, and then divide it by the size of our stop loss in dollars. So just to give you a few examples of that, let's say that my R is $100 over here, okay? And I want to take a 10 cents stop size. If I do that, I will need to take out 1,000 shares of whatever stock I'm taking, right? Doesn't matter if it's Apple or Netflix. If I take a 10-cent stop and I'm trying to risk $100, I will take 1,000 shares. So you can obviously follow the logic here, and you see that the tighter your stop loss, the larger your position size is going to be. So utilizing R basically gives you two immediate benefits. The first is you know exactly how much you're going to lose when you stop out. Okay, there's no game of, oh man, I lost $500 on the last trade, and then on this trade I'm only going to lose $10. None of that. You know exactly what you're going to lose every single time. The second is that this allows you to calculate a risk to reward ratio that you can clearly define and that you can measure and add to your statistics in your journaling. So if you know every single time I trade, I risk $100, and when I win, I make $200, that allows you to evaluate your strategy and see, hey, is this good enough? Am I breaking even? Am I being consistent with how I'm taking profit? So fixed risk, critical topic, and it allows you to mitigate some executional risk. So now that we've introduced the concept of R, let's look at how it works in a real world example. Let's say that you're trading Tesla and you decide to go long off of a moving average. So you go long right here off of this moving average, this orange line, and you want to risk $100. So R is $100. You decide to put your stop loss at $138. So you've entered at 139, you have a stop at 138. Therefore, your stop is $1 and you want to risk $100. So you need to take exactly 100 shares. Very easy math. Now, if you hold until 142 and you exit all of your position right there, you will have made $3 while risking $1. So we say you made 3R and you had a risk to reward ratio of 3-to-1. So that's just a real world example of how it works trading in fixed risk. So now let's talk about how you can continue to mitigate executional risk by utilizing hard stops instead of soft stops. As we discussed, R means that you have a stop out price picked before you enter a trade, right? Because that allows you to calculate your position size accordingly so that you lose only your fixed risk amount. So a hard stop means that you actually set a stop market order at your stop out price that will exit your entire position if this stop is hit. The flip side of that is called a soft stop. You also hear people call these mental stops. So this says you yourself will manually trigger a market order to get out of your entire position when that stop price is hit. The issue with soft stops is that they open you up to this slippery slope pitfall, right? You allow yourself to have the price move past your stop and you say, okay, well, this is just a wick candle. It's just moving down a little bit more. I'm going to stay in my position and I'll be okay with losing slightly more than my fixed risk amount. Well, you do that and then let's say that price flushes or news comes out, and then suddenly now you're 5R down when you only wanted to risk 1R. So this, I promise, will tilt you more than you can possibly imagine in a trade, all right? And for more experienced traders, I think mental stops are fine, but please, if you're a new trader, just utilize hard stops and accept the fact that occasionally you're going to get wicked out of your position and then price is going to move in your direction. But more often than not, this will save you from losing a lot more money than you planned on. Okay, so now let's talk about the last way that you can mitigate executional risk, and this is by fully understanding margin. Trading on margin means that you are borrowing money from your broker in order to purchase shares of a stock. All right? Margin is a fantastic tool for day traders because it allows you to trade a larger position size than you would otherwise be able to by increasing your buying power. You also don't have to wait for cash to settle, which you would if you were trading in a cash account, and your buying power therefore will reset each and every day. So margin overall is fantastic. It allows us to do a lot more with a lot less. However, because of this, your potential loss is also greatly amplified, and technically you could lose more than your original investment or what is even in your account. So let's take a look at what it looks like to win and lose on margin. Let's say that you have a margin account. You have an initial cash position of $25,000 and you have 4-to-1 margin, which is very typical for most brokers. So that would match the equivalent cash account that has $100,000 balance. Let's take out, let's say, a $75,000 position, right, which is quite large, but again, this is just an example. Let's say that you have a total gain on your position of $10,000. So you did a great job. You made $10,000 on a $75,000 position. Therefore, your ending cash becomes $35,000, and you made a 40% return on your margin account. But on a cash account, you actually only made a 10% return on your initial investment. So you can see greatly amplified winning scenario. Unfortunately, the same thing can happen on the downside, and this is where you need to be super, super careful with margin. In this situation, we're going to say same things. We took out the exact same positions, but this time we lost really bad. We lost $30,000. Therefore, in the margin account, you now have a negative balance of your account. Okay, you started with $25,000. You now owe your broker $5,000. Therefore, your return is negative 120%, whereas if you'd had a cash account and you could cover this full amount, you would have lost 30% of your initial cash. So, as you can see, margin is great when you win, but if you're not careful and you don't trade in terms of fixed risk, you can blow yourself up really, really fast. Okay, that's executional risk out of the way. Now let's talk about market risk. Market risk are things, again, related to executing your trades, but these are items that are not really in your direct control. So these are things like trading halts or regulatory news that comes out, economic news, etc. To mitigate market risk, you need to use sites like, for example, tradingterminal.com or seekingalpha.com to be aware of any economic announcements that are happening that day. I'll also try to call these out in our Discord community so that you're aware before the trading day starts. So be aware of anything that's going to happen that day, either pre-market open or post-market open. The second is to read news surrounding the stock before you actually go to trade it so that you make sure there are no regulatory concerns. If your stock is in danger of being investigated by the SEC and that's all over the news, you really shouldn't be trading it. You should just stay away. Better safe than sorry. Finally, you need to understand how halts work, and we'll go over that in the following slides. So all of those are ways that you can mitigate market risk. Okay, so I wanted to show you a quick example of what happens when economic news comes out, just to highlight how difficult it can be and how much it can wreck you if you're not paying attention. So this is basically the aftermath of the Fed coming out and announcing that it's going to be a little bit more aggressive with raising interest rates. So this news hits 4 seconds from now. So here it goes. The news just dropped. And you can see just how ridiculous that flush was in the market, okay? You would not have been able to stop out when you wanted to. You would have taken a ton of type 2 slippage right there. And if you didn't have a hard stop in, you would have just liquidated a huge portion of your account basically over the course of 10 seconds. And you can see just how wild the price movement was in the minutes after this announcement. So always make sure you're aware of any economic announcements that are coming out that day. All right, now let's talk about trading halts so that you fully understand them and you can avoid them more efficiently in the future. There are a couple different types of trading halts that you will encounter as a trader. The first are news halts. News halts are ones where there's some kind of material that is going to come out about a stock that is material enough to warrant halting the market entirely to give everybody times to digest the news before trading resumes. These are typically anywhere from a few minutes to a few hours, and you don't know for sure how much time is going to be taken up until essentially they let you know when the market's going to reopen. Next are regulatory halts. Regulatory halts happen when a company is under investigation for fraud or other regulatory infringements. This is super dangerous. Anytime you hear that there's news of a company potentially going under regulation from the SEC, you need to just get out because the time of the halt can be indefinite and you can have your money stuck in there for weeks or even months. The third type, which is by far the most common, is called a circuit breaker halt. And that is when the stock price moves too far, too fast, basically within a 5-minute window. So if it moves more than 5% in 5 minutes, it will result in a 5-minute trading halt. So all pretty clean, makes a lot of sense. You'll know exactly when the stock has halted and you'll know when it's going to reopen. I have a couple tips if you find yourself stuck in a halt. The first is, especially if you're a new trader, just try to exit as soon as possible, okay? If you took too large of a size, just get out. Don't risk it. Don't risk getting halted a second time. Just exit your position completely. The second is if you are a more experienced trader, right, and let's say you're on the right side of a halt, so it's halting up and you've longed the stock, try to exit most, if not all of your position after the second halt. So in a multi-halt scenario, typically, you'll get one halt and then you'll get a second halt that goes even higher. In my experience, you're better off just getting out after that second one because a third one often is a pretty drastic pullback. Third, ensure that you know the exact minute when the halt will lift whenever you possibly can. And normally it's very clear, your trading platform should tell you, but just make sure that you know exactly what's going to happen so that you don't, again, get caught off guard and then lose a lot more than you're expecting to. If you want to hear more about this, I think Investopedia is actually a fantastic resource, and a lot of this material, especially around circuit breaker halts, I got from them. So again, watch out for halts. Try to just avoid stocks that have a high chance of halting anyways, and you'll be able to tell this as you gain more experience. Okay, so that brings us to our third major risk type, which is structural or systematic risk. This one is pretty quick, pretty straightforward, but it is anything that is related to your physical trading setup. So these are things like internet outages, what happens if your computer dies mid-trade, what happens if your platform breaks down or has issues. And the easiest way to mitigate these is first, with the actual structure of your system, make sure that you have a battery backup. You can buy these on Amazon for like $80. I'll link one in the description. Again, I don't have any particular ties to this brand in particular. This is just the one that I bought. But this is super helpful because if your power goes out at your house, you'll still have a couple of extra seconds where your modem and your computer are running off of this reserve power and you can quickly exit your trade. This has saved me numerous times. Second, just make sure you have a wired keyboard and mouse. Sounds really simple, but if your mouse battery dies, you're going to be really upset because you're trying to click and exit a position and you can't. The second thing you need to be aware of is you need to know how to exit trades at least one other way. All right, with Dash Trader Pro, I actually have an application on my phone, and I can exit trades via that. Or if I absolutely have to, I can go to Interactive Brokers, which is my broker, so not my platform, and I can exit trades with them as well via either their platform or a call if I absolutely have to. Third, make sure that you have max loss triggers set up throughout your platform and broker. So I talked about that back in the executional risk, right? I have a stop that says, hey, if you lose more than, let's say, $500 a day, it will liquidate your position. That will still work even if my platform breaks or my computer shut down. Whatever happens, they'll do that essentially on the back end, and you won't lose more than that $500. So extremely important to mitigate structural risk. It's one of the easiest ones to mitigate, but when this goes wrong, it can be extremely frustrating. So please do what you can to mitigate that. The last risk that we'll talk about today is psychological risk. I'm not going to spend a ton of time on this because, again, we're going to cover it in detail in section 3, but psychological risk is related to how you handle loss, okay? And a big portion of it is how good your self-discipline is. So, in my opinion, this is by far the most dangerous risk because, again, it's internal to yourself. There's no system that you can put in place around it to really safeguard your own mind. The only thing that you can do, at least for now, is really try to start living by these tenets as strictly as you possibly can, okay? Even if you're trading in sim, treat it like real money and follow these 3 tenets. The first is trading in fixed risk. We already talked about that on the previous slide. The second is utilize hard stops. Again, especially if you're a newer trader. Third, which we'll talk about on the next slide, is trying to focus on process over profit. This is a huge step forward in your mental game if you can adopt this framework, but it's something that a lot of traders just don't really think about, particularly early on. Okay, so let's talk about process over profit. I call this the golden rule of trading systems. And basically what it says is that if you develop a strategy and you stick to the rules of that strategy completely 100% accurately, then any future evaluation of your system can therefore be completely objective. Okay? Day trading at the end of the day is all about finding this statistical edge, right? You want to win more often than you lose. And operating in this mindset allows you to really remove the pain of loss. Because if you have a system and you've stayed on track in terms of following your rules every single trade, then you can focus on the long-term success as validated by your statistics. You can say, hey, this trade didn't work out, and that's fine because I know my system has a 55% win rate and I followed my system, and so I'm not going to win every single time. It becomes this objective kind of shield or layer that you can put in front of your psychology. So there can be a ton of different win rates and different risk-reward ratios that you can utilize with this. And just to show you a few examples, I've created this strategy payoff matrix over here. So let's say that you've developed your trading system and you know that your trading system has a 60% win rate. Well, if every single time you win, you make 3R, then for that system, over the long run, on average, you're going to make 1.4R per trade. So if your R was $100, then over the long run, you're going to have averaged out to making $140 per trade. That is something that you can evaluate objectively and something that you can improve over time. So again, trade with the framework of process over profit. I want to make sure that my process and my system works. Therefore, I need to be as objective as possible. Okay, that brings us to the end of our lesson on risk management. A few quick closing thoughts. First, please remember that risk management is critical to your long-term, consistent profitability. The second thing you need to keep in mind is that the earlier you adopt this into your system, the easier it's going to be to follow. So please, new traders, even if you're out there trading in simulator, I know it's not real money, but treat it as if it was real money and utilize these risk management techniques throughout your simulator experience. Last, please remember that you cannot fully eliminate all of these risks, okay? They're still going to be out there. You can do as much as you possibly can. You can follow everything that you learned in this lesson. But at the end of the day trading is still an environment with relatively few safety nets. And you're just going to have to be comfortable with that. So hopefully this lesson helped you. Please utilize these techniques and protect yourself against something that could potentially blow up your account and ruin your day trading career. With that, have a great day, and I'll see you in the next lesson.